Have you ever wondered why the brokers on the floor of the New York Stock Exchange always cheer when the closing bell rings, no matter if the market crashed or soared that day? It's not because they won, it's because whenever you trade, they make money, whether you did or not. Welcome back to the channel. Today, we are diving into the single most important concept in financial history, the difference between an investor and a speculator. According to Jason Zweig's brilliant commentary in The Intelligent Investor, the reason most people lose money isn't just bad luck. It's because they don't know how to sit still. They treat the stock market like a casino where the house has rigged the odds against them. If you want to stop building your broker's wealth and start building your own, you need to understand Benjamin Graham's rules. Let's break it down. Let's dive into the core concepts. Rule number 1, know the definition. Most people think investing means buying a stock, but Graham was very specific. He said an investment operation requires 3 things. Thorough analysis, you must study the facts based on safety and value. Safety of principle, you must protect yourself against serious losses. Adequate return, you shouldn't aim for extraordinary or magic returns, but a reasonable one. If your trade doesn't meet all 3 of those criteria, Graham says you aren't investing, you are speculating. Price versus value. Here is the easiest way to tell the difference. An investor calculates what a stock is worth based on the business. A speculator gambles that the stock price will go up just because someone else will pay more for it. Zweig notes that for a speculator, the constant stream of stock quotes is like oxygen. Cut it off and they die. But for a real investor, you should be comfortable owning a stock even if you had no way of seeing the daily price. The speculation nation trap. Let's look at some history because human nature hasn't changed. Zweig points to the dot-com bubble of the late 90s as the ultimate example of confusing speculation with investment. Back then, people thought trading was easy. Commercials showed tow truck drivers owning their own private islands. People started believing that just because a strategy worked once, it was right. Zweig uses a great analogy here. If you drive 130 miles per hour to get somewhere and you survived, were you right to do it? No, you just got lucky. If you keep doing it, eventually it will kill you. When the market went crazy. During the bubble, things got so decoupled from reality that people stopped looking at businesses entirely. The ticker symbol mix-up. In the late 90s, traders mass bought a tiny company called Temco Services just because it confused its ticker symbol, TMCO, with Ticketmaster Online, TMCS. They didn't even know what they were buying. The red strategy. Even celebrities got caught up. Barbra Streisand admitted in an interview that she traded stocks based on her mood. She couldn't stand seeing the color red in her profit column, so she would sell immediately. That is not analysis, that is emotion. The turnover. In the 70s, the average holding period for a stock was 5 years. By 2002, it was just 11 months. People were treating stocks like hot potatoes. Beware of mechanical formulas. Zweig also warns against magic formulas that promise to beat the market. He discusses the foolish 4 strategy that was hyped in the 90s. It claimed you could crush the market by spending only 15 minutes a year picking stocks. It worked on paper for a while, but it was just a statistical fluke. When people actually tried it with real money in 2000, the foolish 4 stocks crashed 14%, while the rest of the market only dropped about 5%. Graham's law is clear. Once a magic formula gets famous, it stops working. So does this mean you can never speculate? Not necessarily. Gambling is part of human nature, but to survive in the market, you have to follow the rules. Here is your key takeaway for today. If you feel the urge to gamble on a hot stock, a crypto coin, or a market trend, do what Graham suggests. Create a mad money account. Set aside a maximum of 10% of your overall wealth for speculation. Keep this money in a completely separate account from your retirement or investment funds. Never mix the two, and never, under any circumstances, add more money to that 10% bucket if you lose it. Remember, investing is a unique kind of casino where you cannot lose in the end, as long as you play by the rules that put the odds in your favor. If you found this breakdown helpful, hit that like button and subscribe for more insights from the world's greatest investors. Thanks for watching, and I'll see you in the next one.